Hello, students. This is going to be Chapter 9, Deductions, Employee and Self-Employed Related Expenses. So let me share my screen. Okay. So this chapter is talking about the differences between, are you an employee for a company or are you self-employed for your own company? So when you're self-employed, it's like you are the employee of your business. Your business is an entity and you're an entity. So there's two separate entities. When you're an employee, you are just focusing on you as an employee working for some other company. And when we talk about self-employed related expenses, it's the majority of what we talked about throughout this whole semester is that corporate deductions, expenses, et cetera, are usually deducted, but personal deductions are not. Like personal losses are limited, but business losses are not generally, right? So we're going to talk about the differences between what you can deduct as an employee versus what you can deduct as self-employed. Now, the first thing I'm going to show you here is Schedule A from 2013. And just an older schedule. Because in this 2013 Schedule A, which was a long time ago, there was this section here for job expenses and certain miscellaneous deductions. So you see here, we've got medical, taxes, interest, gifts to charity, casualty of theft losses, which are all similar categories to the current 2024. But this part here, the job expenses and certain miscellaneous deductions, this is where we had these deductions that are no longer allowed. So this is not allowed. So if we look at the Schedule A today, 2023, the 2024 isn't out yet. You see, it's got your medical, it's got your taxes, your interest, your gifts to charity, casualty, and then that's it. Right? Casualty, then other. This section is no longer there. So these fees used to be deducted and then limited to 2%. That is no longer options. You'll also see on the current 2023, 2024, the taxes section is limited to $10,000. This is the 2023 and from 2017 and on is limited to $10,000. You can add all your numbers up, but then you add them all up, and then you take the smaller number, 5D or 10,000, whichever is smaller, which means it's limited to 10,000. But when you look at the old one, taxes you paid, there was no limit. So it's important to know when you're doing tax returns, which year you're looking at, because the laws change. Because remember, these are laws, so the laws change. So when we talk about, I'm going to bring it to Form 1040. Our Form 1040 has all these different line items. And we've learned about deductions for AGI, which means deductions above the line, above line 11, which means deductions on Schedule 1 and Schedule D, and then on your line Schedule 1. You'll see that there are other deductions from, Schedule E and Schedule C. If you go to Schedule E, the new one's out, there's deductions on there's so many deductions here, right? So there's so many deductions. When you go to your Form 1040, there's so many deductions above the line. There's just so many different schedules. where the deductions are on these supporting schedules that flow up to Schedule 1 and Schedule 1 here. And so those are all deductions above the line to get you to adjusted gross income. Then you have deductions from AGI, right? You're deducting from AGI, which are your standard deduction, which is everything in this box, or your itemized deduction. You take whichever number is larger. So your itemized deduction is on Schedule A. So your medical, your taxes, interest, gifts to charity, and casualty. So, and this casualty is federally declared disaster only. The old Schedule A wasn't limited, just was casualty theft. It wasn't limited to federal disaster area. So we're going to talk about those for AGI deductions and from AGI deductions, right? So self-employed, between employee and self-employed. We're going to also talk about transportation expenses, travel expenses. So transportation expenses are like your subway, your taxis, your buses. That would be, let's say, in your home country. Let's say you're working for a CPA firm and you go to the office, and then your boss says, okay, I want you to go to our client, downtown, and your offices are uptown. So you need to take a bus or an Uber or a bus, Uber, taxi, whatever. That would be a transportation expense while you're working for your client or for your job. Travel expenses are, I'm traveling from here to another place where I need to stay overnight, or I need to take a plane or a train and I need to stay overnight. Now, while you're traveling in this overnight place, like let's say your offices are in New York and you're going to travel to Kentucky for a client. Well, the traveling from New York to Kentucky, everything, bus, train, plane, to get from your office in New York to your office in Kentucky, plane, train, whatever, those are travel expenses. You can have a cab to the airport or a bus to the airport or whatever. That are your travel expenses. Then when you get to your location, like you fly the plane, you're on a plane and you land, or you take a train and you land, and then you get a train to your hotel or your office, or you get a Uber or taxi from the train or the plane to your office. Those are all travel expenses. But then once you get to your office, and then you're actually there working, and you get, after you work for the day, you're done at the office, and you then take a cab back to your hotel, that would be transportation expenses while you travel. So it'd be travel expense dash transportation. So it's kind of a detail between the transportation and the travel expenses. Deductible and non-deductible expenses. So like, for an example, on your Schedule A, let's say my AGI on page 1 is $200,000, right? Form 1040, line 11. That's your AGI, right? Line 11. And let's say that my medical expense, so there's a limit of 7.5%. So let me just do my calculator here. So I'm going to do 200,000 times 7.5%. So that line 2 by 7.5 is $15,000. So what that's saying is that, let's say my medical expenses are $40,000. So if medical expenses are $40,000, they're limited to anything, this is the floor, which means anything above this number I can deduct. So 40,000 minus 15,000 is 25,000. So when we're talking about deductible and non-deductible expenses, I have a total of $40,000 of medical expenses. $15,000 is not deductible and $25,000 is deductible. So there's lots of examples like this to show you, right? So let's say my state and local income taxes or my real estate taxes are $20,000. And then I add that $20,000 because I have 0 and 0. Well, then it says here, enter the smaller of line 5D and $10,000. So what's smaller, $20,000 or $10,000? $10,000. Let me make this 25. 25. What's smaller, 25 or 10? 10 is. So I have $25,000 of real estate taxes. $10,000 is deductible. The other 15 is not. So other taxes listed here is 0. So now this one is saying add lines 5, E, and 6. So this is $10,000. So we'll go through that a little bit more in detail. And then other business expenses. Qualified business income is a big part of this chapter, but I'm not going to go over it again. We went over it in a previous chapter, so go back to that chapter. I think it's chapter 6. Let me see. Chapter 6 is a detailed review of the QBI deduction. So go back to that chapter. I'm not going to go over it again. It's exactly the same. We've already gone over it and you were tested for it, but it will be on your final. So make sure you go back to chapter 6 and review it. Deductions for contributions to retirement accounts, accountable and non-accountable employee plans, limitations on miscellaneous itemized deductions. That's when we're talking about these other itemized deductions that are no longer deductible. That's what we're talking about here. These unreimbursed expenses. That's what that's about. And then tax planning. So every chapter we have a big picture. So Morgan, a recent college grad with a major in child development, has accepted a job with ECC. I'm just going to say EC because it's too many C's. EC is located in a western suburb of a large metropolitan city, roughly 30 miles from the center of the city. Morgan will be moving into a 2-bedroom apartment 2 miles from EC. At EC, Morgan will work with preschool children Monday through Friday from 7 to 3. One of the reasons she accepted the position at EC is the flexibility it provides. So is she an employee here or is she a self-employed person? She's an employee. Excellent. Because she's eager to pay off her student debt, to pay off her student loans and to save to buy a house, she's decided to freelance in the late afternoons and evenings and on weekends, joining the gig economy. She finds 2 ways to freelance: transporting people and packages like an Uber driver, and tutoring elementary school students in English and math. And her tutoring can be online or in her apartment. Is this a employee situation or a self-employed? Is this employee or self-employed? Both of these are self-employed. She's dedicated her second bedroom in her apartment for freelancing. She's got a large table and several chairs in the bedroom that allow her to meet her tutoring students or connect with them via her laptop. She keeps all of her freelance records in a file cabinet, which she keeps in the closet in the bedroom. She also purchases and keeps various supplies for her tutoring activities. This could be all stuff that she deducts as business expenses because it's freelancing. And there's freelance driving that she does. And so we'd have to know what is transportation, what is commuting, and what is business miles. All right. Employee versus independent contractor. What's the difference? So if you're a person who works for themselves and has your own business, then you would be self-employed. You put yourself on Schedule C, and all of those deductions are for AGI. If you're an employee and you don't really have any deductions other than your itemized deductions, that would be on Schedule A from AGI. Now, again, from 2018 to 2025, these miscellaneous deductions are suspended That's the ones I'm talking about here. They're suspended from 2017 to 2025. So if you're an independent contractor or an employee, so how do you know if you're an independent contractor? So sometime when I first got out of college in 1993, I was getting jobs because it was a really, really bad economy and there wasn't a lot of jobs out there. And the way that it is today, where companies are actively coming to colleges to offer internship opportunities. Back in my day, you actually had to go out yourself and find the opportunities because they didn't actually come to the school. So I had internship opportunities, but then when I graduated, it was not, everybody was hiring what they called temp to perm. And these independent contractor rules were not really in place. And so a lot of companies, what they would do is they would hire you as a independent contractor, temp to perm, because why? They wouldn't pay you for stuff. They wouldn't take your taxes out. They wouldn't take your federal and FICA out, like I taught you about in a different class. They wouldn't take the federal and FICA out of their pocket, Medicare and Social Security out of their own pocket and send it to the Medicare office and the Social Security office. They wouldn't take out the federal unemployment and the state unemployment for you. So you basically were treated as a self-employed person, even though you were an employee. And back in the day, you wouldn't know to take these self-employed taxes out yourself and then deduct them on Schedule 1 of your Form 1040. Now, back in the day, there wasn't a Schedule 1. Everything was on page 1. But here you have deductible self-employment tax that you can put here. So when you were an independent contractor, all of these expenses here, everything in yellow, your employer didn't have to take anything out. Plus, if there was a 401k or there was insurance, all of this stuff wasn't taken out of your check. So that would save the employer all this money that they wouldn't have to take out of their own pocket. So I was actually considered an independent contractor because that's what they hired me for, only because they didn't want to pay for this stuff. But then after this was happening for years and years and years, and people weren't actually getting hired, they were just constantly getting like 3 months here and 3 months there and always kind of fighting to keep their job, which is what happened to me, which I always kept my job, but I kept getting promoted and finally got a permanent position because the IRS started making these rules that the following items provide a worker is established as an employee. If the company furnishes the tools or equipment and a place to work, then that means you're not an independent contractor. So my first job was with Verizon, and I would go to their offices and I had to follow their rules and I had to follow their, their hours, and I had to do the job that they're asking me to do. So in a way to think about it that's differently is, let's say, for example, you are, you're going to a job every day versus an employee and contractor. Let's say, for example, you want to redo your kitchen and you hire a contractor to redo your kitchen. You're not going to supply them with their tools and the equipment that they need, right? They're going to come with that. They're going to come with their tile cutter or the tools that they need to actually, take take out your old kitchen and do demolition and, sledgehammers and hammers and nails and things like that. So you're not going to furnish those. Your contractor will bring those. So when you go to a job, your company's going to give you a computer. You're not going to bring your own computer. They're going to give you a computer that you use of theirs. Providing support services, including the hire of assistants to do your work. If I go work as a manager or senior manager at a CPA firm, they're going to give me support services. But if you're a contractor going into an office, I have to make sure that I'm doing all my copying at my own office because I'm not an employee there. Training for the workers for the needed job skills. Are you going to hire a contractor to redo your kitchen, but train them to do the work to do the kitchen? No, they come with that training already. But if you went to go work at a new company, they're going to train you to do the job if you're an employee. Okay. And then some extra things that you can read. So this code is a new code. It requires businesses that pay $600 or more in a calendar year to a contractor to issue a 1099. And why is that important? When a company issues a 1099 to you, a copy of that also goes to the IRS. So the IRS knows that you got paid this money, so they're looking for it on your tax return. Statutory employees are people like Uber drivers. They're not really, they're an employee and they work for Uber, but they're really self-employed. So it's a difference. It's in between an employee and a independent contractor. So life insurance agents, home workers, and other salespeople, you're not necessarily working for the company per se. You're working for Uber, but Uber doesn't really pay you. The person that's actually driving, you get a piece of what they pay Uber. So you can claim the business expenses on your Schedule C. So you can read a little bit more about that. So self-employed and general relief. We're going to talk about transportation, travel, moving, education, entertainment, and other. That's what the other categories there are. If you have an expense and you get reimbursed by your company, you can't deduct it. Okay? Any reimbursed expenses you can't have. So, transportation. What's a qualified expense? The cost of transporting the self-employed taxpayer or employee from one place to another within the course of the business, not in travel status. Taxi, automobile tolls. Commuting between your home and office is not a deductible expense. It's once you get to the office and you're going to clients or going and doing business, that's transportation expense. So if you're driving your car to go on business, you can get 67 cents per mile plus paid fee. So a lot of times when you work for a company and they say, okay, drive to this client, you basically keep track of your miles and your parking and tolls and your mileage, etc. And then you'll basically turn that in usually to your employer and they'll reimburse you. And that way you don't actually put that on your tax return because you're reimbursed by your employer. But just say in case they don't reimburse you, then you can deduct it on your tax return. But it's usually there's two ways you can do it: automatic mileage or actual cost. Automatic mileage is the cents per mile plus parking fees and tolls. The actual cost is keeping records of all the expenses and depreciation on your actual car. And you would do both methods to see which one gave you a bigger deduction at the end of the year. Because Morgan will have an office in her home and 2 freelancing business, our apartment will be her principal place of business. So that means any transportation from her home to the freelance site is not a commuting expense. Commuting expense would be if her home is her office. But let's say she rented an office in Manhattan for doing her freelance work. And she lived in, let's say, a suburb. Sorry, my neck is really bothering me. I hurt my neck today. And she lived in a suburb. And she drove to her office in the city. That would be a commuting expense. But in this case, she has her office in her home, so she's not actually commuting. So anywhere she goes, she's from her office. Anywhere she goes is not a commuting expense. It would be transportation. But now, if she's driving for her home to the ECC place, that's her as an employee. That's a mileage. That's commuting expense. During Morgan's senior year in college, her parents gave her one of the family cars, a Toyota Camry. She has no idea of the car's original costs, so she cannot do the actual cost method because she doesn't know the cost of it. She can keep track of miles driven for business because she accepted her new job. So what she can do is when she gets into the car, she could have, there's an app on your phone, or you could have a little notebook that says, here's starting the mileage, when I got in the car, I look at the mileage. She looks at the mileage and writes it down. And then she gets to wherever she's going, and then she writes it down. And then she subtracts it to get 10 miles commuting. Then when she gets in the car again, she writes down the miles for when she got in the car, which should be the same miles as when she got out before. And then when she drives wherever she's going, if that's for work, then when she gets there, then she'll say business miles, and then she'll keep track of that. Or you can use an app to do it. So she wants to document her miles appropriately because she can only deduct business miles. She can't deduct commuting expenses. She knows the IRS expects to keep track of her. So she wonders if there's any mobile apps. A number of mileage tracking apps are available that will help her to log her miles. Okay, so here's some examples and you can look at those. And there's a knowledge check. Travel expenses. So this is when you're traveling away from home, right? So avoids duplication of living expenses where the taxpayer incurs expenses while at home and while working away from home. So let's say, for example, I'm paying rent in my apartment. And then when I leave and I go away and I travel somewhere and I get a hotel, I'm paying for the night of my rental and where I live, and I'm paying the night of the hotel. That's why it's saying avoids duplication, because you can deduct your traveling expenses of the hotel, or, because it's like you're paying double. It includes transportation expenses, meals, and lodging while working away from home. You have to, overnight need not be a 24-hour period, but you must be overnight. Like you might arrive there at 5 o'clock at night, go to a 6 o'clock meeting or a dinner, stay over, have a business meeting from 9 to 11 and leave at 12. You weren't there for 24 hours, but you stayed away. It should be a temporary situation, not in excess of a year. There was a time when I first worked for Arthur Andersen that I was down. I would go down to Atlanta, Georgia at a client site, and I stayed at a hotel, and I was down there for 6 months, but I was at a client site, right? Tax home is the area where you work in. Conventions, no deduction for travel unless it's directly related to your business. So if I'm a tax CPA and I go to a convention, which is like a CPA convention, I can deduct that as a travel expense. But if I'm a CPA and I go to a convention that's talking about how to relax and it's a spa, well, that's not my trade or business. So here, a doctor attending an out-of-town seminar on estate planning would not be deductible because that's a doctor. They don't do estate planning for a business. And there's some restrictions applying for spouses of dependent. There must be a business reason for them to go. Education. If you're going uneducated, let's say you say, I'm going to travel the world and I'm going to travel because I want to get a broad education of meeting cultures and this and da. It is not, that kind of education is not deductible because it's not specific to your business or what you're studying. The education does qualify as a deduction. If it does qualify as a deduction, the travel involved is allowed. That would be something like, let's say you're getting a degree in hotel management and you travel to from America to Italy, and you're going to a course on how to use international travel for your business. That would be something that's education for your business, so that travel would be deductible. What if you have business and pleasure? Let's say you're going on a trip and it's a business trip and your boss says, I need you to go from Monday to Friday. And you decide, you know what, I'm going to stay the weekend because I have a friend that lives in that city. So I'm going to stay the weekend. So depending on if it's domestic travel versus foreign travel, there's different rules. But how is it, what can I deduct for my transportation expenses and my travel expenses? Again, my transportation expenses are while I'm traveling, my trucks, but bus, Uber, and trains. Domestic travel. If the business trip is entirely within the United States, the transportation is deductible only if the trip is primarily for business. So primarily business would be I'm going away for 5 days. I'm going for business, and I decide to tack on a travel thing. That's primarily for business. Not primarily. Pleasure is primarily for pleasure is your friends and I, you plan a trip to go away for 2 weeks. And then you say, you know what, we're going to Milan and I have a client there. So I'll go to lunch with my client while I'm there for the 2 weeks. That's not primarily for business. You're not going for business. You're going for pleasure, and you're putting in some business while you're there. So no transportation expenses qualify as a deduction if it's primarily for pleasure. If it's between business and personal days, if it's primarily for business, you can take the days that are personal and not deduct them, and the days that are business, and you can deduct them. Foreign travel is a little bit different. The transportation expenses must be allocated between business and personal, unless the taxpayer is away from home for 7 days or less. So if you're gone for 7 days or less, you can deduct the whole thing as business. Or less than 25% of the time was for personal. You can deduct everything. Again, foreign travel and record keeping. You must keep track of everything while you're there, while you travel, and have those records so that if you ever got audited, you'd have the information. So if it's foreign travel, if the trip is primarily for pleasure, no transportation is deductible. Travel days are considered business days, and weekend legal holidays are provided both the weekend legal holidays and intervening days are considered business days, provided that both the day before and the day after were business days. So I have an example here. Is the holiday deductible? Is it Friday? Not traveling, it is while you're there. No. Only succeeding day is business. No. So is the holiday deductible? It is the Friday. If you're not traveling, it is while you are there. No, only succeeding day is business. So Friday, the day before that is a Thursday, which is a business day. The day after is a Saturday. So this says weekend legal holidays and intervening days are considered business days, provided both the day before and the day after were business days. So since this is a Friday, no, because the succeeding day is a Saturday, it's not, because the 2 days, the day before and the day after, are not business. Okay. Education expenses. So if you're a self-employed taxpayer and you are go back to school or something like that, well, what of the education expenses of going back to school are deductible? So if you're self-employed, they're deductible if it's to meet a specific legal requirement to keep your job. So let's say, for example, when you started working at this kind of your company and you had a certain degree, but now the law has changed and you have to change your degree and you need to go back to school to be able to keep that position. You need to go back to school to keep it. And this is for self-employed. Or to maintain or improve existing skills required in the present job. Education expenses are not deductible if it meets the minimum educational standards for your existing job. So this is a little bit different. You're in this job and you don't actually meet the minimum educational qualifications, and your boss says, okay, we're going to promote you, but you have to go back to school to meet the minimum educational standards for this role, and we're going to give you 6 months to do it. That is not deductible. Okay, because it's the minimum standard versus this is a legal requirement to keep the job. To qualify for a new trade or business, this is only to keep the present job. That's deductible, but it's to qualify for a new one. It's not deductible. legal requirements to keep the job. Expenses can be deducted if the education is required by law, not the minimum degree required. And you can read those. What are the expenses you can deduct? Tuition, books and supplies, transportation from office and school, travel while you're away at an educational program. Other provisions, the encouragement of education is desirable social goal. So Congress continues to enact laws to provide tax incentives. So back to the big picture. After starting her new job, Morgan enrolls in the evening master's degree program in child development at a local university and begins attending classes. Although Morgan believes that the master's degree will be useful, it's not a requirement of the EC. It's not needed to maintain or improve an existing job. So none of her education expenses are deductible. However, the tuition and fees will qualify for the lifetime learning credit, which is something different. Other business expenses, office in the home. So she's using her second bedroom as an office. So if that's just for business and for her self-employed business, then she has ability to deduct some expenses for personal use assets that are not deductible. Office in the home expense is allowed for self-employed when a portion of the residence is used exclusively and on a regular basis as a principal place of business for trade or used by clients. So her second bedroom would qualify as a home office. Now, again, in the old, you can deduct these things, but now in the new, from 2017, you can't. That's what they're talking about, 2018, 2025. Can't deduct those. What is a principal business? Home office is a principal place of business if the office is used by the taxpayer to conduct admin and management activities for your trade or business. And there's no other fixed location. Like you can't have an office someplace and then your home office, one or the other. Can't deduct for both. Now, for the home office, you can do either the regular method or the simplified method. And you can check each year to see which one is better and pick the right one. The regular method is relevant expenses are categorized as direct or indirect. Direct expenses are deducted in full. Indirect expenses allocate between business and personal. So repainting the office, buying a desk, buying a computer, all of those are direct expenses. Home office insurance, insurance for your house or your home or the lights, the utilities, those would be indirect expenses. So the regular method, home office expenses are used in a trade or business and they're deductible for AGI, which means they'd be on your Schedule C or you'd be on your Schedule E. But your home office expenses cannot create a loss. But amounts that are allowed as itemized deductions must be deducted first. So your mortgage, interest, and real estate taxes would go on your Schedule A first, and you would not deduct them also on your home office expenses. Any disallowed home office expense can be carried forward. The simplified method is a simple deduction of $5 per square foot and no more than 300 square feet. So I have an example here. Okay, so I have a home I have 2,100 square feet home and my office is 200 square feet. My direct expenses are I painted the office and I bought a desk and a chair. That would be direct expenses that you'd add. So I could either do the regular method or I could do the simplified method. So the simplified method is $5 times a square feet, and it's limited to 1,500, right? And my square feet is 200. So 200 times 5 is 1,000. That's my 1,000 right there, right? That's my 1,000, 200 times 5. But the limit is 1,500. So let's see what we'll pick. We're below the 1,500, so it'll be 1,000. So here we say I have monthly expenses for electric at $500. So 500 times 12 is yearly, 6,000. I've got cable at $200 a month, yearly is 2,400. Mortgage is 2,000 a month, yearly is 24, and so on and so forth. So now my office allocation. My office is 200 of the 2,100 square feet. So I do 200 divided by 2,100. So my office is 9% of my home. So I'm going to take the 6,000 and multiply it by my 9%. My 2,400 times the 9%. My 24,000 times the 9%. The 12,000 times the 9%. So multiply my office, add these all up is 42,228. So which one would you pick? 42,228 or the 1,000? I would take the 42,228 because that is more of a deduction. Okay, so $5,000 if I did simplified versus regular, which is better. My revenue is 5,000. My expenses are 1,000 if I'm simplified. It's 42,228. My net income is 4,000. 5 minus 1 is 4, or 5 minus 4, 2 is 771. So 771 is a lower income times my tax rate is a lower tax. And then look at which ones to be considered. And there's an example for you that you can use and go over on your own. Moving expenses. Before 2018, you used to be able, let's say your boss says, oh, I want you to move to California. I'm like, all right, go to the California office. Okay, so I'd fly to California and look for a place to live. That flying to California and the hotel and looking for a place to live and renting a car, all of those moving expenses I would deduct on my tax return. And let's say I then bought a place, some of those expenses would be deductible. Then I had to pay a moving company to pack up all my stuff. I would deduct those expenses. And then I'd have to move my stuff. And then I'd have to sell my apartment, blah, blah. All those expenses from leaving, selling, traveling, moving, packing, all that stuff would be deductible. But now those moving expenses are suspended from 2018 to 2025. The only people who are allowed to deduct everything are members of the armed forces or their spouse or dependents on active duty who move because of the military order that relates to a permanent change. And entertainment and meals expense. No deductions allowed for an activity generally considered to be entertainment, amusement, or recreation. Membership dues are not allowed. A facility is not allowed. Taxpayers may still deduct some of all or food and beverages with the operating of their trade or business. A business meal with a current or potential client, or meals consumed by employee with travel. Only 50% of food and beverages are deducted. It used to be 100, now it's 50. Now, think about subsidized eating facilities. Prior to 2018, there was an exception of 50% that they could deduct, but now it's limited. And then after 2026, these deductions will be eliminated. So what happened was lots of companies decided to build a cafeteria on, let's say, one of their floors. And then they would subsidize, meaning that they would pay part of the fee for the cafeteria to be there. And they would have, let's say, a carving station, a salad station, a sandwich station, a Asian station, a Indian station, a pizza station, a sandwich station, sushi station, all these different. But when you would come downstairs to eat your meal, you would be able to pay a lot less because the employer was paying part of that. That means subsidizing it. part of the cost of having it there, because they would rather you eat in the area and be done quicker and go upstairs back to your office. And that's what that's talking about, subsidized. So that 50% limitation has to be the full value of the meal. It has to be directly related to business. It has to be recreational, social for the employees. Meals provided at the business retreats. Business meals are only deductible if the expense is reasonable, the taxpayer is present, the food and beverage is current or potential business or customer is with you, and if combined with entertainment, the meal and beverage is separately itemized on the bill. Business gifts are limited to 25%. Record keeping is important, and you can read the rest of that. This miscellaneous employees expenses, what I described to you on your Schedule A, that's no longer allowed. It's gone from 2018 to 2025. This used to be something that was deducted. It's on Schedule 1. Educator expenses. This used to be listed here under unreimbursed employee expenses. You'd put your expenses there, but now it's on Schedule 1. So a lot of this stuff is not allowed anymore, but there is a small deduction up to $250 that's allowed on your Schedule 1. Now it's $300. It's $300. But you have to have worked 900 hours, and they're unreimbursed. And there's a knowledge activity for you. The qualified business income, this goes over it again from 66. There's an example there. Another example, all the way to 103. So that's something, again, Chapter 6. Okay, retirement account. If you go to your Schedule 1, you'll see IRA deduction is right here. So if you put $2,000 into an IRA, you could put the $2,000 right here. That's what that deduction is. So there's other types of retirement accounts. There's like a 401k, there's an IRA. So retirement plans are employee IRAs, retirement plans, Keogh plans, other options, 401k plans, SEP plans. So you can read about what all these are, but basically, if you deduct, this is what I showed you up here, when your employer deducts a 401k or pension or whatever from your pay, it's always pre-tax, which lowers your adjusted gross, and your federal percentage is not based on the 1,000, it's based on the 900. So you're actually getting this for tax-free because it's put away for you tax-free. So those contributions are tax-free, but if you pay something like after taxes, like you take the net pay $696 and you put every month you put like $100 into your IRA, that's after tax. So when it's after tax, that's when you can put it on this line. And then there's other types of plans you can read more about. Employee expenses, accountable plans and non-accountable plans. Accountable plan is that your employer has an accountable plan or a non-accountable plan. You have to look and see. So if your expenses are reimbursed by the employer, then neither the reimbursement is reported and it's not a deduction because you're already getting reimbursed. You have to, if you're not receiving the money back, you have to have receipts to show that it happened. If you don't have the receipt, you can't deduct it on your tax return, because if you get audited and you don't have that receipt, you'll have to pay interest and penalties. So a lot of people don't take that chance. You should have the amount of the expense, the time and place of travel, the business purpose, and the business relationship. Non-accountable plans are plans that do not require accounting or return of the excess amount or both. All expenses are reimbursed and are included as wages. Any allowable expense is deductible in the manner. So if I had an expense and it was included in wages, then it's basically a deduction for me, which is reducing my taxes. And then they give you some examples to read, and then a knowledge check. Limitations on itemized deductions. This is the amount that I showed you on. Let me just move this here. Enter the amount from form 1040 line 38. That was your AGI, because there used to not be a schedule 1. So page 1 and 2 and 3 and 4, there was 4 pages of your 1040. So your AGI was moved down. So you put your AGI there times 2%, and then it's limited to that amount. Those deductions are no longer allowed. And they give you the examples of what those are that are no longer allowed. And then your knowledge check, and it goes over the big picture for you. So if you have any questions, it's been really great to meet lots of you throughout the semester with emails and Zoom calls and things like that. But if you have any questions, I'm going to post this Excel file on your